that's what's so different in between residential and commercial is you got to really understand how these businesses work, and the reoccurring revenue, how they make money, because you're going to sell that tenant's financials on your exit, or you're going to
Yeah,
invest capital improvement dollars into that tenant. And I don't think a lot of people understand that about commercial real estate is that
mhm.
you're not just investing in real estate, you're investing in the tenant that operates out of your real estate.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back to another episode of Decoding Cash Flow. Today we have a very special guest, Andrew Dunn, who is a managing partner at VAC Development. Andrew is a real estate developer and an operator focused on land development and value add sectors directed at commercial real estate. Andrew is involved in acquisitions, capitalization, and business plan execution of his firm. Andrew, welcome to Decoding Cash Flow. I just kept the introduction very succinct, small, so that
Yeah.
you can we can dive deep into exactly what you do during our podcast, and maybe you can explain our listeners more better on what exactly you're doing for your
Yeah.
resume in focus,
Yeah.
right?
Yeah.
So,
Ted, great to be on, and thanks for having me. And love talking real estate and love talking deals in general. Um, so for me, my name's Andrew Dunn. I'm managing partner of VAC Development, like Ted said, based out here in Las Vegas. VAC stands for Value Add Cowboy Development. Literally, it was three guys who came from family office backgrounds and said, "What are we gonna do? What deals do we look at?" And we were like, "Well, we're not like Red Rock Capital or Blackstone or Vanguard or any of those. Like, that's just not
uh-huh,
us. Like, we're just deal junkies, man. We've done everything from your buy the land, flip the land in escrow, home flipping, home building, uh, industrial
mhm,
development, mixed use redevelopment, taking on broken construction projects and finished them. Your simple like, hey, buy an underperforming asset and fix it up. Self-storage, office, hospitality, water rights. I mean, you pick it. We've kind
you
of
name it
almost
and
done
you
it.
got it.
I haven't done high-rise development. That's kind
Okay.
of on the bucket list, or a giant
Uh-huh.
mixed-use, suburban development. But those are on the bucket list for sure. But at the end of the day, we call ourselves value-add cowboys because we look at any
Mhm,
deal that makes sense and where we can generate alpha. Alpha is
okay.
that difference that I make from just collecting a coupon check, right? I don't do coupon check collecting deals. For me, it's where can I buy a deal, enhance the revenue from when I bought it above my what I invest and sell for a profit.
Mhm,
Typically we're merchant guys, so I'm not really in a deal longer than 5 years. Have we been and are
okay.
we? Yeah, we have some opportunities deals. There are 10-year holds or long-term legacy asset holds, but for the most part, we are go in, fix it up, and get out. And for those right assets, we'll
Mhm,
hold for a long term, but you got to find the right equity partner. So we are
okay.
OPM users, we're leverage buyers. I've done everything from buying all cash, 40% bank debt, all the way up to your 97% financing in the stack. So for me, it's what's the deal? How can I make some money for me and my investors and give a nice performing asset on to somebody else?
Okay. So you gave details about what you do right now, but let's take a step back, right? What I would like to know is before you get started in the real estate, what did you do, and what was the situation, or what attracted you towards real estate?
Interesting enough, we'll go back to where I grew up. I grew up in Southern California, near the beach in Laguna Beach and Dana Point area.
Mhm,
Parents got divorced at a very young age. I was about 4. My mom remarried a couple years later to a custom home builder in Laguna Beach. He's built about like 150 beachfront homes. And I'm now 28, so been with him through a lot of those builds. Just as a kid seeing it, not involved, right? And then my dad was a serial entrepreneur, had a lot of ups and downs. So I saw that side of the thing of like just a hustling entrepreneur, like, hey, what's this business? Hey, what's this? How do I research that and become successful at that? And then I went off to university up in Washington and fell in love with a girl. My biological dad passed away, unfortunately, and I had to handle all that. But the girl's dad said, "Why don't you come work for me down in Las Vegas?" I said, "Okay, well, what do you do?" He says, "Well, I do commercial real estate and real estate investing." I was like, "I don't really know what that is." They don't really tell you what that is, right? You just kind of think these buildings exist, but you don't really understand how they work for a majority of the
Yeah.
population, right?
Yeah.
And he's like, "All right, I'll give you $800 a week, and you and my daughter will stay in one of my apartment complexes for a year. I'll take care of the rent." And I was like, "Well, what's my job description?" He's like, "You'll figure it out." And I was like, "I'll figure it
Mhm.
out." And I think that was just the theme for my career is I've always tried to figure it out and find the right people to bring together and partner up with the right people. So came to him, I've been in this business a little over 6 years now. Always in Las Vegas, but I've done deals in Reno, Phoenix, Hawaii, Southern Cal, now Florida and Arizona. And so we're looking. I like going to different markets, seeing different people, different asset classes. But in that journey, I cut my teeth. I was like, well, where do I add value? I'm a kid out of school. This guy's not. He uses you just kind of it's like sponge learning. You either sink or
Yeah.
swim. So I was like, where can I add that value, make some extra cash? I got my real estate license. And then, I was like, okay, well, we flip homes. Like, I was like, how do you guys find your deals? And this was like in the early days of like Facebook groups and like meetups, right? Where you can go in and like go into Mace Facebook meetup. I was like, I'm a cash buyer and XYZ, and you can go find some deals with some wholesalers, right? Vegas became very competitive. I flipped about 70 homes with them. Learned that business for everything from your like mobile home trailer and real property conversion up to
Mhm.
your luxurious multi-million dollar home in a gated community. So I think that taught me a lot about the town because I saw so many different zip codes, like gonna go tour that house, gonna go tour that house, gonna go tour that thing. And I
Mhm.
figured out how that worked. But ultimately I always want to do commercial real estate because the dollars were bigger, less pool of competition, more or
Yeah.
less. And it's just bigger. It's fun. It's
Yeah.
like how you can't scale a house business, in my opinion, effectively. Yeah, obviously people have done it, but the level of success of scaling a house business versus going and doing a fund or larger deals and creating a development and investment team for commercial real estate is a lot more feasible. So that's kind of why it leaned me into there, and that's where we are today.
Yeah. And looks like your your in-law was the main mentor for you, right?
Yeah.
He was the one who got you into commercial real estate. And
Yeah, he was.
yeah, and to find such a mentor, that's a boon kind of thing, right? You can hardly find someone who can hold your hand, teach you what exactly needs to be done, all the strategies, process, everything. So it gives you an edge over anyone else who starts new and try to find a mentor or try to learn through the books, podcast, or whatever.
Yeah, I mean, I'll tell you, what's funny enough is the daughter and I didn't work out, but the dad and I did. So he's
Oh,
not my in-law, but he's still my mentor. And daughter's amazing, wonderful. Found somebody else, has a couple kids, wonderful. Uh, my mentor has been absolutely one of the key components of my success. I always tell people like, well, how do I do it? I was like, find somebody who's rich or wealthy or who you want to be and
yeah,
serve them and be a copycat, show your loyalty to them. And if they're great, they'll open up the world for you. And if they're not, somebody else will see how valuable that loyalty is and that work ethic is. So again, there was no for like formal teaching. It's been funny. I've taught kids out of Penn, USC, Harvard, like all
yeah.
these real estate development schools, and I'm like, all right, what do you know? And then they just told me about an Excel model, and I'm like, what? Like,
In
you
the
even
real
know how
life,
to
it
like
doesn't
read a
work that way.
contract? That's like, I mean, dude, in our firm, like, I go through amendments, contracts, prospecting for properties, getting properties under contract, building a business plan, go and find debt, go and find equity. Actually understand the construction side of things. That's not my strong suit. I'm not even gonna say that, but I've been exposed to so much, and I'm so grateful. But you're not gonna be told what to do every day. And it's
Yeah,
if you want to go work, I always tell people that are coming out of college, do you want to be very specific in what you do and you're like just a number, but you're in this big corporate, you're going to learn something, but you're only going to learn asset management. You're only going to learn leasing. You're only going to learn debt. You're only going to learn construction. Or do you want it, but like it's clear and you're going to make some good money, but you're picking a path for yourself. Or do you want to go in a family office where it's not as structured, there's chaos every day, but you're going to be exposed to so much, wear so many hats, and your
Yeah,
perspective is going to be two, three, five times of the guy who went in the corporate route. But that
that's
corporate
true.
route guy is going to have a step above you, another guy. It's pros and cons to both paths. And I always tell people, what do you want? You know,
Yeah.
but you have to ask that question to yourself first before deciding what you really want to do.
Absolutely. And as you said, right, some of these family office, they give you exposure of every kind, all different
Yeah.
kind of investments, starting from sourcing, funding, till the closure of the property and disposition of the property too. So it's a great place to be. And as you said, right, find a good mentor. I my career in real estate also started the same way, almost like, I found a friend of a friend who was in the construction business, and I worked for him for free for some time, about 6 8 months. Learned everything from him. I just followed him. He told me, okay, do this. I just with my eye closed, I just did whatever he asked me to. And after a while, I just split, and then started my own. Started with fix and flip, and now we do ground up constructions of luxury single family homes and multifamily properties, small multifamily, not the larger ones, but mostly in the residential section. We're not pivoted to commercial yet, but yeah, it might be good. I had that in the back of my mind, like because commercial properties, what I've seen is there's not much exposure, not much knowledge around in the commercial properties. So once you have a good understanding, you'll find less competition from the people dealing in residential. That's for sure. Yeah,
Yeah, I mean, I'll tell you what, I've gotten a nice education learning on a marketability of leases, right? Like in
hmm,
multifamily, like it's not that important. But in commercial real estate, it's all about the financials of your
yeah,
guarantor. And what
yeah,
that operation does in retail, what's the secret sauce of, oh, I need the dentist, I need this many restaurants, I need a breakfast concept, a dinner concept, a Mexican and Asian, an American concept, I need that coffee concept or cafe, I need people to come in here, the dry cleaner, or whatever. And what I always say is like, that's what's so different in between residential and commercial is you got to really understand how these businesses work
yeah,
and the reoccurring revenue, how they make money, because you're going to sell that tenant's financials on your exit, or you're going to
yeah,
invest capital improvement dollars into that tenant. And I don't think a lot of people understand that about commercial real estate is that
hmm,
you're not just investing in real estate, you're investing in the tenant that operates out of your real estate.
yeah,
And that's something that's really cool to me. I'm not really a public equities like stock investor guy. That's not my thing, but I get it. I give my monthly amount, but overall, like but you have to understand those components, right? Because
yeah,
like perfect example, you go to Starbucks changing their CEOs, and because from the Chipotle guy. What happened to
yeah,
Starbucks stock went up, almost 20% in a day, and Chipotle went down
hmm,
10%. And
yeah,
or it's like you see Family Dollars closing, or you see, Big Lots closing 350 for 99-cent discount stores, like, or even just like certain California restaurants I've seen close because they couldn't fundamentally operate off of the wages that California now set to their new minimum wage levels. So
yeah,
you got to pay attention to all these different things in commercial real estate that really actually affect the businesses, which then
yeah.
inherently affects the value of your commercial real estate. So,
And as you said, right, one national tenant, you get a one national tenant in your mall, or and here the property value goes up just
yep,
like that. Yeah,
yeah. I'll tell you, it's interesting though. I'll tell you, we've been looking at. We are more interested in non-credit than credit, and it depends.
yeah,
If you're doing a single tenant build, I want credit, right? Because I can take that credit to a bank and I can get 90, 100% debt financing on my project.
hmm,
But what does credit do? They beat you up and they can drop you quickly. Just like how I said, Family Dollar closes a thousand stores. Well, because they have a couple thousand stores.
yeah,
But, Ted and his wife or his, partner of some sort goes and has a coffee shop, simple neighborhood cafe, but that's their life. they're going to do
Yeah.
everything they can to make sure that cafe operates. Now, is their
Okay.
credit a little weaker? Yeah. But I also know I can backfill that space if the location's good enough to another non-credit user. And there's not all these like default provisions and just this thing, that thing, this exclusivity. It's just like you got to understand that the smaller credit spaces, if you believe in American entrepreneurship and that
Mhm.
small businesses are the backbone of America, well, then you want to bet on the small businesses trying to succeed. Yeah, a lot of them turn over, but if your space is good enough and well designed, you're going to have somebody backfill that space in under 6 months, and you're not going to lose a lot of cash flow. But you're going to have more of a relationship with those tenants versus, okay, I am calling the 500 store retailer and I'm going through this customer service department, that customer service department, or that real estate department, and you don't even like have a personality because you're just a number. It goes back to the corporate versus family
Yeah.
office structure, right? Like,
Yeah.
okay, yeah, I'm going to deal with a little flack of the non-sophisticated mom and pop owner, but I'm going to go on to, betting on that person and not having to deal with the sophisticated things. It's pros and cons of both, right? I don't think a
Yeah.
lot of people realize that.
And so now coming back to the different kind of asset class in the real estate, right? You mentioned starting from fix and flip, you went through, many different asset class. What's your main focus as of now? Like, what do you see in the future? What are the opportunities that you see in the future in those asset classes?
I think for me, it's still industrial and retail.
Okay.
I think, yeah, and also I think office. Really, I
Mhm.
think now we were always office guys to a certain degree, but I'm really just gung ho on commercial real estate. I'd say a majority of my time is focused on retail, because you're able to really get some understanding of how the market works a little bit more and the discrepancy between new construction development for retail versus second, third gen spaces. The rent differential is
Mhm.
significant, meaning like for new construction strip retail, you got to be in the mid $40 rent average across the country. But those
Mhm.
second, third gen spaces that are across the street or even in the same submarket are at $20 rents. And so what's that telling me? Okay, if I'm signing leases at $45 a foot across the street, go buy the center in the same trade area that, has the same fundamentals or demographics. And I can buy that center when the rents are $20 and I can get them to 30. I'm not ever going to get them to 45, but I can get
Mhm.
them up 25, 30 with just being an active owner, pushing them and saying, hey, I get it. Your rent's been low a really long time. Well, the submarket vacancy is under 5% and people need to be here. And there's
Mhm.
no space
Yeah.
under 3,000 feet available or under 5,000 feet available. So I'm going to backfill that space. And then, so we really like that kind of play. So that mark to market opportunity there. And then I still believe in industrial. I think there was just a lot of big box space delivered across the country. Everybody thought COVID was the new normality. That's why retail took a hit because people didn't understand the experiential or the essential service retail. And they were more focused on this big box e-commerce demand. E-commerce isn't going away. More
Yeah.
and more people are ordering on their phones, right? But that's shifting retail. You're still going to get your nails done if you're a girl. You're still going to get your hair cut done
Mhm.
at a barber shop. You're still going to go grab the coffee. You're still going to consume.
Yeah.
It's
There
just
are
what are you
certain products you
consuming?
cannot ship.
Yeah, you can't ship
Yeah.
that. You know what I mean? And so, but industrial, like again, going back to small business America, small bay is still invaluable. But I think what's happening with industrial is there's so much of these 500,000 plus footers built or these big high, clear height buildings, but a lot of people don't need clear height. They need like 24 feet or maybe 32. But people need to demise down, and I think you're going to see a trend of right sizing. I think the
Mhm.
biggest trend in industrial real estate right now is right sizing. You know, I don't need 500,000 feet. I need 300. I need 400. But people were signing these leases during COVID because if they didn't sign the above capacity or above use space requirement that they needed, they were going to lose the space to somebody who was just going to sign the lease. And what you're
Mhm.
seeing now is a lot of givebacks. So give back of, if you're in a 200,000 foot building, somebody's giving back 50%. They're doing 25% reductions. Okay, but what happens to that space? You built that for a single tenant. Now you got to go build out an office. Now you got to go shift and do the demising wall. And I think that's a big deal. Um, and tenants have more options. And these people who own these 1960s, 70s, 80s buildings were getting spoiled because there wasn't enough new construction in the market for a tenant to choose from, and they just had to take what they could get. And well, now the power is more in the tenant. We still believe in it long term, but I think there's just going to be a short blip in the market where some developers just mistimed it and landlords mistimed it and they're going to get hurt. Just like in multifamily.
Yeah,
Nobody thought interest rates were going to go up forever. Like they decided, hey, it's flat, they can't go up. Well, they all went up and you guys all had floating rate debt. You guys got
yeah,
screwed. And you can't cover your interest payments. Your taxes went up, interest payments went up, maintenance went up, and it's not a fixed cost that you can really bill back onto the tenant. And so, what I like about commercial real estate versus multifamily is when you look at multifamily, I use a simple like back of the napkin because I'm a dummy, is the 4/1. Meaning, if I make 100 grand a year, I could spend 25 grand a year on rent in a traditional suburban market, right? If I go
yeah,
to Manhattan or something where that's more urbanized, that number creeps up to 2/1. If I make 100 grand, I could spend, 40 to 50 grand on rent because
mhm,
I have public transportation. I don't have a car to pay for. And so to me, that's a high amount of money that somebody's spending on their gross earnings over their housing costs. Where if you look at industrial, or you look at office, or you look at retail, some of those they don't really creep up past 10 to 15%. And so I think that's a key metric to understand is like those rents still have room to grow onto the operational side of these tenants. And you can really work with them to understand why you have to be that way and invest more back in like, hey Ted, you own the shop or you own the little like warehouse like operation or whatever. Like, what do you need? What do you need more signage? Like, can I do like more of that? Like again, in multifamily, you're doing the new countertops, the cabinets, the flooring, the paint,
yeah,
the more the fixtures, right? And that can help you. It's the same principle, except usually that tenant is going to leave and it's a higher turnover, right? It's every,
yeah,
12 months a tenant's moving. Now that's been shifting. More tenants have been, and multifamily have been staying in the same spaces, but they aren't as much like, but in commercial, like most of these people, if they stay there, they're there for 5, 10, 15, 20 years because they've operated at that level. And human migration patterns shift all the time. So multifamily, it's kind of hard to right size, but people always need a place to live. And that's why multifamily will always be good if you buy it right. It just depends
yeah.
what the risk you're going for.
Mhm.
So
And it's all about the numbers, right?
100%.
Regardless which asset class you go. And uh, the as as we talked about earlier, right? The competition is more in multifamily, so it's very hard to get the right get any properties at the right number as of now,
Hmm.
And so yeah, the other thing is when you talked about this industrial, uh, you, it's more about like a flex space kind of concept that you are talking about, or maybe because there are in industrial also, right? Nowadays, people have started talking about data centers. So I'm not sure how much are you involved, or have you looked at data centers at any point of
Yes.
time?
Yeah, yes,
Yeah.
we have. We've been trying to work with Nevada Public Utility on some power to go for a data center. I think it's one of the best asset classes to go be into. It's very competitive. It's
Okay.
probably the hardest asset class to enter. I
Really?
think you
Okay.
have to be really smart. It's not an asset class I'd recommend to anybody besides a person with an extreme bandwidth of human capital resources to go research and find and dig, who understands how public utilities work, who have a development background. I don't think you can do a data center deal on a reposition if you don't understand development because you have to understand how power works and you have to understand how water works. Um, you have to understand how you don't have to understand the data center business, but I mean, you just think about right now, we're using a transmission of audio and video, and this data is being stored somewhere, and it's going to be uploaded somewhere to hit audience.
Yeah.
And we're not the only ones doing that at this point in time. There's probably thousands of other people that are doing it at this point in time as we're recording. And people and humans are creating, cell phones are getting into the hands of more people every day. This data has to be stored somewhere, you know? And so I don't think it's going to go away anytime. It will get more efficient. Just like how Office has, you don't need 100,000 feet. You now need 25,000 feet or 50
Yeah.
or whatever it is. But to me, ultimately, it's all dependent on the capital. that you have, and where's the power? Where's your
Mhm.
power? And to me, like if you don't have the power, it doesn't matter. But because these hyperscale facilities are now needing minimum of 100 megawatts up to
Yeah.
300, if not more. And there's a lot of these companies that, just like industrial, traditional logistics, have done, um, 3PL, third party logistic uses. And so, like, all right, I'll lease 100,000 feet of a warehouse. But again, I'm just gonna keep using you for these different businesses. Maybe you have a lot of them, I don't know. Is all right, Ted sells cookies. Okay, and then that person over there sells, like dolls, like baby dolls, and that person sells this and that product, that product. And well, they only need like a couple thousand feet of space, but they don't want to operate it. So they'll go ship their project to that 3PL, and that 3PL will do all the logistic shipping for them, and so that's why industrial logistics took off so much. Again, I think people still need it. I think just inventory costs are high for where interest rates are at right now. But for
Mhm.
data centers, people will buy that space. Like if industrial dirt for traditional industrial development for logistics was $10 a foot, that data center dirt, if you have the right amount of power, will be $30 to $40 a foot. They don't care about
Mhm.
your land price. So if I was a guy who wanted to get in the data center space and be a dummy, I'm not going to build out an industrial facility for a data center. I'm going to go find some piece of dirt with water, and I'm going to go secure power from the local power utility, and I'm going to go hire a big institutional broker, and I'm going to then go and flip that dirt, or I'm going to go
Mhm.
partner and take a carried interest. Because if an industrial building costs $1 a foot to build, a cold storage facility costs $2 a foot to build. A data center facility costs 50. If you're using that like apples to apples
Mhm.
comparison, it's a 50 times cost, um as much as a traditional industrial building. So these TIs and just are just incredibly high. And these build outs are
Mhm.
so specific. And I am not that smart to understand that. Just I'll be a dirt flipper, you know,
Right. Yeah, maybe one day.
right?
Yeah. So, in the industrial space, are you do mostly development, or it's just you buy the old, do the value add, and just turn it around?
Definitely a mixture. We've done
Mixture.
the value add, we've done office to industrial conversion in Phoenix.
Okay.
Where we've converted a single story office building into industrial. Broke ground on two industrial projects this year. I bought some value add industrial, you
Okay.
know. It just depends what the deal is, man. Where it is. Where's the arbitrage? Where's the opportunity? What's happening in one market that I saw happen in another? And where can I capture that arbitrage for maybe that local guy doesn't see what I see? Again, to me, it's more about I think there's a true value in playing in your backyard, but there's nothing that beats being in person and getting on the plane or getting in the car to go understand the market
Mhm.
and understand how something operates and how somebody else operates because you will see the arbitrage, right? I mean, we're
That's
seeing
right.
here in Vegas where Warner Brothers is waiting on some film credits to announce like an $8.5 billion long-term investment into Las Vegas. And they're calling Las Vegas because of what we've had with sports and entertainment. Like it'll be the sports and entertainment capital of the world soon, right? And I
Mhm.
think I don't think we're far off. I think we're probably a decade or two off. But we are replacing, Hollywood and supplementing Hollywood to a certain degree, and I think you'll continue to see that. So again, people who are in LA when Warner Brothers and all that stuff took off are like, oh, I see it happening in Las Vegas. I'm gonna go buy real estate. I know the value doesn't make sense to anybody who plays there and has played there for the past 20 years, but I know what happened in LA. It didn't make sense there. I missed it. I gotta jump in now. And you can see that, right?
Yeah.
So
It's all about, keeping ears to the ground, what's coming
100%.
up. Yeah. And when you so when you're sourcing these deals, the industrial deals, what are the specific criterias you have in mind? Like, okay, it needs to be certain thousand square feet, like 50,000, minimum 50,000, or it needs to be in this area, or the neighborhood should be something, what are the different criterias you have?
How close am I to the interstate? or like
Okay.
the main thoroughfare, like so transportation wise, like and how
Okay.
close am I to the next city that I'm transporting to? If I'm doing, something not in a coastal city, what's my drag cost? So that's how you
Mhm.
kind of identify a market. Is there's an opportunity where one place's drag costs are better. There's like Reno has a cheaper drag cost from a shipping container out of the Oakland port to Reno
Mhm.
than it does to the Inland Empire. Or no, Inland Empire is a little cheap, is like about the same price, but it's better than Vegas and it's better than Phoenix and it's better than Salt Lake. So
Mhm.
if I'm not in California, I have the cheapest drag cost and I can deliver to 48 state, sorry, I can deliver to 10 different states and both the Canada and Mexican border within 48 hours under the federal trucking laws. So to me, like traffic wise, logistically, it's one of the best in the West.
Mhm.
You go down to Phoenix, there's an abundance of labor because it's flat. And there's a saying in Phoenix where it's you can drive till you qualify. So the warehouse worker can't afford a home if they're willing to commute far enough, right? Um, but then you look at, all right, what's my cost of power? Okay, well, what's the cost of power in the area? Okay, is there an abundance of water in the area? What's the cost of water and connecting? Is sewer easily exportable, or do I have to do some remediation to the sewer? What are my labor laws? Again, where's the abundance in location? How close am I to the interstate? How close am I to that labor supply? Again, what is can I store something? And I think this is a bigger trend in industrial is a lot of these guys in the new developments have maxed out coverage and they've gone away from the cross dock facilities, they've gone away from the yard. So we've been looking for something that's not 40+% coverage. We've been looking for more 30% and less coverage or 35% and less coverage. We don't mind the 40%. We just think it's a good opportunity to have a yard component for material laydown or additional truck storage instead of having those tenants have to store those trucks and materials somewhere else on an adjacent site. And then that reduces your risk of relocation by the tenant because they can store their trucks and materials on site. Again, what's the power? I think more often than not today, going back to the data center conversation, can I upsize that power? Can I, get that to 4,000 amps? I mean, like the 2,000 amps it's gonna be fine, but I'd rather have 4,000 amps than I'd rather have 2,000 amps, right? I'd rather
Because you
have an
never know
abundance
what
of
the
power.
tenant needs, right?
Yeah,
So,
but and it's just the modern day. If you believe in
yeah,
artificial intelligence and you believe more of an automated sequencing, then you're going to want to focus on power because that's a supplemental infrastructure component for AI to operate out of.
that's right.
And so for me, it's where's the power? Like I think power is more of a focus than clear height now. I'd rather have a 24-foot clear height building with an abundance of power than a 36-foot clear height building with not enough power in the
Mhm.
same location. Like to me, the power is more of the driving focus in the future than not. I think it's also a dependence of like, okay, where's the market at? Do I need to focus on cooling? Like in Las Vegas, they placed a moratorium for new development on swamp coolers, which use more water than, HVAC units. And so that just increased my cost to build by $10. Well, it doesn't just increase my cost to build by $10 a foot or $5 to $10 a foot, depending on like what the cost is. It now increases also my common area maintenance bail backs on the triple nets back to the tenant. So I'm more sensitive. Maybe I would pay a premium for a swamp cooler, used industrial building in Las Vegas because I know new development requires HVAC. And what a lot of people don't realize is they just think rent is, oh, it's $1 per foot a month. Well, no, it's $1 per foot a month base rent plus my triple nets. And if I can be
Yeah,
at $1 per foot base rent with 15-cent nets, okay, I'm at $1.15 effective rent, to the tenant. That's their operating cost for real estate. Okay, but if I'm at a 20-cent, CAM figure and I'm doing apples to apples building, that cost is $1.20 to the tenant. Okay, $1.15 because I have more sustainable building. I want to be more in that, right? Like because
that's right.
my tenant's going to operate 5 cents a foot and a higher profit, then he's going to want to stay in my center because I'm keeping his costs low, right? Because I'm building solid. Because remember, think about it. 5 cents a month, a year is what, 60 cents? Okay. All right. You do 60 cents on 100,000 feet. That's a lot of money.
That's a lot. Yeah,
Dude, that's 60
it
grand a
adds
year.
up.
It
Yeah.
adds up. Like you count pennies in a lot. Don't think a lot of people really think about that. I think another component is understanding the office build outs where the restrooms are. I like to have a restroom inside the office and a restroom outside of the office because warehouse workers, usually they separate them.
Yeah.
Office workers in the warehouse are office workers. Warehouse workers are warehouse workers. They don't like to cross-pollinate.
Yeah.
And when you look at that, I think those are some key components. Also, is there a truck well, or do I just have grade level doors? Truck well is always more in demand than a grade level, in my opinion. Because again, if I can, and also, how wide's my truck court radius? Can I fit a 16 wheeler back there? Or no, I can only get the U-Haul truck to go behind there, and that's more suitable for a grade level. I don't need a truck well. It's never going to be effective.
Yeah.
But, and can I also drive in? Do I have a drive-in door? Can I drive trucks in? Can I drive cars in? So that's also a component. It's like, all right, there's the flexibility there. What's my ratio of office to warehouse? If I'm in a big box distribution space, you don't need more than 2 to 2.5% of office build out to the warehouse. Okay.
Sure.
What's my column spacing? Traditional logistics is like it ranges, but like 50 by 54 feet per column. It's like
Mhm.
standard. So you like for stacking and racking. Um, is there natural light coming in? Again, how do you cool it? What's the insulation like? What kind of, because that opens up to like what kind of goods a tenant can store that could be your competitive advantage to your competitive set. Um, Parking in industrial is not that big of a deal for the actual workers. It's never been like that much of an issue I've seen.
Yeah.
Parking's always relative, but again, like that trucking radius and how easy it is to get in and out of that facility is keen. And then the last thing I'd say is security. Like having a gate and an iron fence, not a chain link fence, that is like one of those things that's so simple about it's like having a pool in an apartment complex versus not having a pool. It's a cost that's pretty minimus if you have scalability that sets yourself apart from everybody else. Because more and more often not, people are breaking into these facilities. And they know
Mhm.
you put the logo on side of the building, Amazon's in there, or whoever's in there, Levi, whatever, and people are gonna come in, they're just gonna try to steal crap. It's annoying. But so sorry, I just
Yeah.
gave you a little
Yeah,
bit
that was a really good feedback and things that needs to be considered, while being in this sector, or while investing or building in the sector. So we talked about the location and the structure of the building. Now coming back to like cost metrics, like what are the different cost metrics you keep in mind while buying a particular facility?
give me an example of a cost metric.
Uh, like for example, let's say you don't want to get into the area where the rent is less than $20 a feet, or you buy in the area where the prevailing rent is more. You can do a value add, uh, you know
Yeah.
and get the
So
rents up, or maybe
yeah,
change
so
the lease terms, etc.
yeah, so I think the key is always looking at the inventory, right? It
Mhm.
goes back to that new development versus old development. So I look at the underlying submarket, and you always want to really be under 10% at a minimum.
Okay.
Um, go to the tighter submarkets under a 10% vacancy factor, and under a 5%. You always talk to a leasing broker. You talk
Yeah.
to the tenant rep brokers. What tenants are in the market? What was the last three leases you guys did? Why did you guys think they did them? Um, so again, I'm more of a market guy and like understanding that, not like than just like pure numbers. But again, I'm looking at what is my cam cost, and I got to make sure that I'm in line or below market on my cams. And where can is there a sewer issue? Is there a water leak? Is there an air conditioning issue? Like, what kind of like maintenance am I really looking at? Industrial, I like it because it's a low turnover for the most part, and it's a low,
Low
um,
maintenance too, right?
yeah, it's a low maintenance. Like
Low
like, again,
maintenance. Yeah.
like in
Yeah.
multifamily, you're doing a lot of paint and carpet for the most part. Like industrial, what am I really doing besides paint?
Mhm.
Like, and maybe like some electrical upgrades. Like if that's like it's a couple bucks a foot. It's nothing, so you earn that money back really quickly within like usually the first 3 to 6 months of rent that you get, you earn back that TI recapture. And I think that TI recaptures are very big for things like that in retail. The TI recaptures, typically 12 to 24 months at a minimum, at a minimum. Sometimes you might get lucky if it's a really good environment and you got a really good built out space, but most of the time it's 12 to 24 months. So that's kind of what I'm thinking. The cost metrics, like I actually it was funny. I just got off a call today with some brokers out in Texas, and they're like, "Well, what's your minimum deal size?" And I was like, "I don't like going on price because what happens if you give me 100,000 foot building for $10 a foot? You
Mhm.
know, like, am I gonna say it's gonna happen? Like, no, but like, well, Andrew, sorry, I don't want to put the deal in front of you. It's $1 million for 100,000 feet. I was like, put that in front of me. I'll flip that sucker around for 10 million. $100 a foot. I go do my thing. So. I never look at it like the minimum deal I'll look at. We've done like the single net turnaround. I'll only do a single net turnaround deal if I have a tenant in tow or if I know I can just backfill it with a tenant, right? Like a burger joint, fast food, auto shop, like if I know I can backfill it. Usually on a square footage size, going to that. I don't like less than 20,000 feet. It's just not worth our time. 20,000 feet is really only for retail for me. For industrial, it's like, oh, why am I doing this? So it's just the yield has to be higher. The yield return has to be 100 to 200 bips higher if I'm going smaller.
Then the
You
debt,
know, yeah, it's just
yield
like it's
versus
hard to
debt,
get
right?
debt,
Yeah.
it's hard to get
Yeah.
equity. Um, it's pain. So again, if you're looking for a cost metric on return on cost, there's no secret to what we do. I look for a minimum of 150 to 200 basis points of spread to do a deal. So my
Okay.
minimum, okay, a pretty moderate, like pretty conservative, 150, moderate 200. If I can get
Mhm.
my head around that on an untrended basis, I'm there.
Yeah.
And then
Uh,
but
uh,
that's kind of it over my exit cap spread, right? And you're usually factoring in 5 to 10 bips a year in cap rate expansion through that process, unless I'm in a contracting environment, then we just lay it flat. I never underwrite downward trending cap rate exits. If anything, it's what we buy it at is what I get it at, or what I buy it at, and you do a little expansion year over year.
mhm. And in the current market with the interest rate this high, are you able to find a spread?
Yeah, it's a
You are.
lot harder.
Yeah.
It's a lot harder, and for the good deals, they get bid up. I think that's why I'm saying I'm hitting more markets now than ever. I'm looking in Boise, I'm looking in Colorado, looking in Arizona, looking in New Mexico, Texas, Florida, like go to the market, like go figure it out. When we go into a new market, usually want to be at least 20 million in deal size.
Yeah.
But we would go down to 15 for the right deal. It just kind of really depends.
And what are the good markets, top three markets in your view as of now, or upcoming three
I
top
can't tell you
markets?
that, then everybody's gonna
Yeah,
look there. No, I'm just kidding.
you gotta give me some secrets.
Um, I think growth markets overall in terms of states.
Mhm.
Texas, Florida are probably my top two. And then the third is, I think it's North Carolina. It's probably, I'll give you the five states that I really like. Texas, San Antonio, Austin, Houston, Dallas, Fort Worth. Florida, with Tampa, Orlando, Miami. North Carolina, I'd go Raleigh and Charlotte. Ohio, Columbus and Cleveland and Cincinnati. Uh, Arizona, Phoenix.
Mhm.
I'd go there. Nevada, nobody come here. It's horrible here. It's not. If you don't live here, you ain't gonna survive. It's honestly hard to find deals here, straight up.
Really?
So good
Uh-huh.
luck. You know.
Yeah, maybe because I'm from New Jersey, so I was just thinking, if I can look around in Jersey, and if you have anything upcoming in Jersey or any ideas that that I can use.
I just saw Trammell Crow, big boy developer, right? Like they're the pro. They're in the pros of real estate development. They just go look up Trammell Crow's new logistic facility they just completed in New Jersey. Probably the most beautiful industrial buildings I've ever seen in my life. Like you just guys see the facade, even the roof looks like it's out of a movie. I don't know, I'm just kind of weird,
Uh,
but um, great access, great retention ponds and everything, and it's just gorgeous. So go check it out. I mean, listen, Jersey's close to a port, so I think there's
yeah,
some opportunity there. That's just a different market. I have
yeah,
no
it's a,
idea how to understand, right? You'll beat me. You'll
yeah.
beat me every time. But go for it.
No,
Happy to point you in the right direction.
yeah, I'm just trying to see, get into this industrial space. Let's see how it goes. But
Hey,
so now,
always help out.
yeah, now talking about the capital, right? Um, but what are your main source of capital for these projects funding?
Family office partnerships. I'd
Yeah.
say family office partnerships, strategic debt, our own internal capital sources.
Mhm.
Just started syndicating recently. Been definitely a new journey for us. It's one of those things where I think the syndication is a long runway, but it's the best way to do deals because you have complete control over the capital.
Yeah.
But we really try to back end and keep a pulse on the fund equity. These guys raise, the money from the pensions or the endowments, and we go after them and say, what are you looking for in regards of like return metrics, right? And how can we, just get in touch and just kind of figure it out. And all right, you need that. All right, I'm gonna go make offers based on your return metrics and what's your check size, what's your product type, what's your target market, what's your target hold period, and let's go put some deals in front of you and go from there. So that's kind of how we see it.
And how did you build this relationship with family offices? Where did you get all the contacts?
You go through equity brokers. I think the
Okay.
biggest thing is what I've learned in my life is as you're growing, pay the fee. Pay
Okay.
the fee. Either hire somebody to go out there and source it for you, or go pay the equity broker fee, the 2 to 3% to connect you to that family office. And it's 2 to 3% on the equity that they invest. And yeah, it's a little expensive initially, but your deal's either good or not. And if you can't afford another 2 to 3% from them, can you really afford to do the deal? And the equity, people know that and they'll kind of take a look in consideration of the deal and then they'll factor in the fee. And I think it just kind of is always interesting in that regard. And yeah, I mean, so and then just showing up to conferences, posting online, doing podcasts, getting in front of people, always being connected and just keeping a consistent online presence and a consistent presence gets you noticed by a lot of these guys.
Mhm. Any specific conferences that you'll recommend where you can
IMN,
go?
IMN,
I
the
mean,
IMN series, I think is just
uh
a phenomenal family office connector, and it's
okay.
sophisticated. You're not going to some, newbie space. I don't think you're gonna. You like everybody dresses the same. They're all in sport coats and sport
Mhm.
coats, dressed up, slacks. Like I never see a guy wear a polo at those conferences, and or a lady wearing some business pantsuit or some dress, and it's a different prestige level, but it's also very expensive, and you pay to play. I think you got to understand if you're paying somewhere to be somewhere, like why are you doing that, and who's going that, who's speaking, who's talking, like if you're hearing some online internet guru and a bunch of Instagram guys going and speaking on stage, I don't think it's a good conference.
Yeah.
If you're seeing the CEO of Blackstone, the president of this bank, president of that debt fund, the real estate director of that endowment. Like if you're looking and seeing those types of people as panelists and the topics that they're discussing about, that's where you're going to go find the money. So I always say people look at the agenda, look at the panelists,
Mhm.
and then look at who the sponsors are of the events and what they do and who they are. And if they align with you, go do it.
Yeah. And I've seen like the IMF, right? They have different topics, different subjects, on which uh, they arrange this conference based on the areas. Like in Nevada, they might have different topics, uh, or New York, they might have family offices coming in. So, any specific conference or the location of the IMF conference that you recommend?
I always go out to the one in Newport Beach or sorry, in Laguna Beach, California, Dana Point, California. Go to a coastal city or major metro. They're only in major metros. They're only in like Los Angeles, San Francisco, Dallas, Miami, New York, Chicago,
Mhm,
I think. Yeah, they're in big metros where people can easily get in and out of or they have a desire to be at.
mhm. All right. So, hey, Andrew, loving this conversation. All right. But just wanted to be mindful of the time also. Is there anything else that you like to tell to our listeners before we move on to the final round of questions?
Yeah, reach out to me on LinkedIn, reach out to me on X. I'm pretty open. I keep a pulse on my DMs and email. Again, we're all trying to make money. There's winners and losers kind of everywhere, but if we can all win together, I think it's a great strategy. If you want to invest, hit us in. We'll put you in through the system. If you got a deal, throw it at me. We do partner up on deals with other operators. We'll bring the equity and the expertise. We'll
Mhm.
pay you a fee or we'll, bring you in on the deal on a carried interest. Again, if you think you have an opportunity based on for us based on what you heard on this podcast today, reach out to me online on LinkedIn or on X. It's just my name, Andrew M. Dunn. So,
All right. Sounds great. All right. So moving on to the final round of questions, Andrew. Are you ready?
yep.
All right. So, which is the one book that you'll recommend which had the most impact on your life or on your business?
Couple. I always change this answer because I always changes based on what I'm going through. I think Pitch Anything.
Okay.
Pitch Anything's a really good book if you don't really know how to sell. Um, it's basically when you have nothing showing that and portraying that you have something to conceive the message and execution of what you're trying to get in your end goal. Wonderful book. Pitch Anything.
All right. What is what are your main source of information to learn and grow?
What's one? Sorry, say that question again.
What are your main source of information to learn and grow?
Oh, sorry. Constantly articles
Okay.
online. I have like 15 different publications that I always listen to, that I always like read every morning. See what's going on. Commercial Observer, Connected CRE, CoStar, Wall Street Journal, Bloomberg, Western Real Estate Business Review Journal, or The Real Deal. Um, yeah, honestly, I think articles are just exactly what I always keep going on. And then I listen to like the Walker Dunlop podcast, the All In podcast, and then kind of pick around between brokerages, like some like CBRE has a good podcast and some other guys for podcasts. But yeah, again, articles I think is the biggest thing, and white papers and reading prospectuses if they come out.
Mhm. All right. What is the best business or investment advice you'd like to give to listeners?
Suit up and show up. I think in a world of doing a lot of business online through Zoom and through the phone, showing up and dressing up like in this like age of tech, like where people show up in a shirt and jeans and sneaks. That's not gonna get somebody's attention as much as me showing up in a suit or in slacks, button-up shirt and a blazer, and being respectful, looking good
Mhm.
and just following up. And so I think just like being in person and that connection really sets it apart. How does somebody remember me? Hey, dude, I'm a redheaded guy and I'm loud and obnoxious and I talk a lot.
Yeah.
And then you'll be like a week later from a conference, I'll be like, hey, remember I was that redhead like out of Vegas, made a couple jokes that you didn't laugh at. And yeah, let's go do some work together, man. And I think
Yeah.
it's that belly to belly. Like you hear people like, oh, they go out drinking with somebody or they go have a meal. Like again, dude, we're human we're pack animals as humans. So if we're
Mhm.
pack animals as humans, like somebody's gonna be more comfortable with me meeting me in person, me bringing them a coffee. It's as simple as that. Um, it doesn't have to be extravagant, but showing up and meeting in person and shaking somebody's hand, looking them in the eye goes a long way.
Yeah. As people say, like the first impression is the last impression, so you got to be perfect.
Yep.
Yeah. All
So
right.
that's it.
So the final question, Andrew, how can Decoding Cash Flow listeners get in touch with you?
Yeah. Hit me up on LinkedIn. LinkedIn, or X,
Okay.
honestly. Or go to the vacdevelopment.com website, fill out the investor form, and start seeing the deals we're working on, seeing our monthly reports, and just see what we're talking about and writing about. It's the best way.
Sounds great. All right, Andrew. It was a pleasure having you on the show. It was a great show, and we'll stay in touch.
Thanks so much, Ted. Really appreciate it.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.